Good morning, everybody, and thank you for taking the time to join us on our Investment Outlook 2021. I'm Brett Lancaster, the CEO of UBP in London. We have labelled our Investment Outlook for next year Brave New World. I'm assured by my colleagues in research that this is a reflection less on our dystopian future and more on the opportunity set that we have currently with regard to cyclical and accelerated trends. We have four speakers today. Norman Villeman, our global CIO, will be kicking the event off. He'll be followed by Marco Pabst, Peter Kinsella, our global currency strategist, and finally Victoria Leggett, who oversees our environmental investing and impact investing strategies. We're going to try and keep this as interactive as possible. We know that these webinars are a little bit tricky. Obviously, we'd be delighted if we could be with you in person. So we're trying to make the best of what we have. There is a box on the bottom of your screens whereby you can ask questions. We think the best way to manage this is for each of the speakers to present first. That will take roughly 30 to 35 minutes. When that is over, we'll then open up to the questions that folk have asked and really try and make this as interactive as it was last year at the Four Seasons. So without any further ado, let me hand over to my colleague Norman Villeman to commence the presentation. Thank you very much.
Thank you, Brett, and thank you, everybody, for joining us today. For those of you who have joined us at the Four Seasons in the past, you'll know before we tend to look forward into the new year, one of the things we like to do is revisit the conversations we had at our last Outlook to see how we've done. And recall, in June, we had our first, if you like, global webinar in the post-lockdown world and really laying out our vision for the future. And as we look back on this first 6 months, it's played out to a large extent very much as we had expected. We've seen this unsynchronized recovery around the world, with China in outright recovery, whereas here in Europe on the verge of a double dip. From a market perspective, even though markets were richly valued both on the equity and credit side, we did think they were going to continue forward on the back of recovery as well as on the back of stimulus going forward. But that meant that rich valuation, that risk management was going to be very key. And so that's played a key part of how we've navigated the second half of the year. Two of the key messages that we gave in June this year was really trying to look through the interest rate volatility that we expected to come, and indeed has come, and really focus on the spread compression that we expect to move through at the behest of central banks. And that has played out very much as we had hoped for. And then lastly, the start of a US dollar bear market, which began in March, played through really all the way to the year end. And Peter Kinsella is here again to take us through what we see for FX going into 2021. So on the following slide, where we want to begin in our look forward is really, again, with the global economy, because this is the anchor for very much how we think about the world. And with lockdowns moving through most of continental Europe and parts of the United States, one of the things, as I talked to clients over the last few months, is this fear, renewed double dip, renewed relapse in the global economy. One of the key messages we want to leave with people is the situation today we think is actually quite different than what we saw in March. When you can see on the left-hand panel, you saw a dramatic shutdown in the global economy, leading to the sharpest recession we've seen in really over a century. What we've seen over the last few months has been something really much more gradual from here in both the United States and Europe, even though Europe has gone through much more harsher lockdowns. And so from that perspective, that alone is a better scenario than we saw in the first half of the year. The second piece of the puzzle that has only really emerged over the last few weeks is the vaccine story. And encouragingly, even though we've seen a rebound in the economies, what you can see on the right-hand panel is the consumers have been rather cautious about this rebound. So consumer confidence remains relatively contained. So as those vaccines are deployed, and indeed there in the UK, that may come very soon, this rebound in consumption activity going forward on the back of increased confidence has the potential to give us another uplift to growth next year. So in contrast to the very sharp contraction in the global economy that we saw in the first half, we think 2021 holds as much as a 5% growth in the global economy. And if we get a good vaccine deployment on a reasonable scale, really beginning in the middle part of next year, we think that could add as much as another 100 basis points to our 5% growth target for next year. And one of the reasons for that, you can see on the following slide, has to do with what's happening in China. In contrast to where we were at the beginning of the year, where China was the epicenter of this outbreak, when China was in outright recession, China has not only moved from recession into recovery, but really in the last few months into outright expansion. What we mean by that is the manufacturers are producing, and we're seeing the consumer start to grow and grow on a year-on-year basis, no longer just on a month-on-month basis. So that anchor for the second largest economy of the world actually moving into outright expansion, we think lays a strong foundation for the recovery story going into 2021. And central banks in particular, we think, stay very much engaged, even though we're starting to see this early sign of recovery. And one of the reasons for that is their new focus, not on inflation, but in particular on unemployment. So using the US example, even though we're seeing some of these temporary layoffs come back, the thing to focus on is what's happening in the permanent layoff perspective. So at nearly 2.5 million jobs lost in this cycle, we're seeing a recession that looks really just like any other normal recession in the United States going back to the 1970s. Not as bad as the global financial crisis. That's largely due to this policy mechanism that's been deployed since March. And for that reason, we think you should expect the Fed, the ECB, and central banks around the world to stay engaged in that area as well. Augmenting that in 2021 will obviously be fiscal. We think that will be led in Europe, but then coming later in the United States. When we talk to clients, though, and even if they acknowledge this recovery that's coming through, one of the key questions they ask is, isn't this already in the market? And we can see that analysis on the next slide, where what's always pointed to is valuations are where we were at the turn of the century, and indeed they are. But one of the key things, and one of the key things we'd like to point out to people is from a valuation perspective, even in the 2000s, valuations remained very elevated. But what got markets to fall was really the turn in the earnings picture from accelerating to decelerating to outright contraction. If you contrast that to what we're seeing today, we obviously saw in the first half of the year rapid contraction in earnings. Now we're at the nascent levels of reacceleration. And then in 2021, we think earnings can grow in the mid-20s. And if we get a vaccine moving through, perhaps some upside surprise even to that number. So it's not the valuation we necessarily want to be focused on. It is the earnings. And we think there's really two ways that earnings are going to grow in 2021. And we have Marco, who's going to talk a bit more about the cyclical aspects of the earning growth, and we're finding some opportunities. And then Victoria is going to highlight one of the longer cycle trends that we see in regards to climate change, et cetera, that we think will be an impetus to earnings going forward the next decade. For investors who are much more focused on income, you can see on the following slide, the big question that's facing them is how do you generate income in a no or low yield world? And I think fortunately for a lot of people, the answer to that really lies in Europe's experience over the last 6 or 7 years. And we think what's going to happen going forward is governments around the world having moved to effectively zero nominal and negative real government yields, we think many of these governments will turn to negative inflation-adjusted corporate yields as well, which is something the Europeans did a few years ago. And so this spike that we saw in the middle part of the last decade where positive yields moved into the picture, we don't think occurs. The suppression of yields should stay in place going forward. And like in Europe, what that means is you want to move out the risk curve, move on to different yield curves. And so that means emerging market debt. One of the areas that we focused on is the Chinese government bond market, where you're not only getting 3% carry, but as Peter will talk about, it's one of the currencies that will capitalize on the weakening US dollar regime that we see going forward. So you want attractive carry, you want currency that can augment your total return. We see the same type of story playing out in the European bank cocoa market. And so moving off of your home yield curves to find those yields, something the Europeans have been doing for the last 5 or 6 years, is something that investors in sterling, investors in dollar as well, will have to pursue going forward. That also means a move into alternative strategies, long-short credit, as well as liquidity risk premium. So private debt markets is going to be an important way to augment returns and total yield in this no or low yielding world that we see going forward. On the following slide, this question of risk as we go forward is going to be very important. Quite a number of people have flagged inflation as one of the key risks in 2021. We're a bit more sanguine on that. Inflation is recovering, just as we've seen in the last 2 crises. And so as we move into the end of 2021, we should see about 2, maybe a little bit more inflation in the United States. It's really in 2022, 2023 that there's risk of upside, a surprise to inflation should be more concerning. What we are a bit concerned about, and we've started to see this play out in the Gulf most recently, but on an ongoing basis with China, is the shifting geopolitical dynamic. And so this withdrawal of U.S. leadership, we think, has the probability to create increased regional tensions that have the potential to disrupt markets and create increased volatility. So much like we've seen over the last couple of years, this proactive risk management story is going to be very important for investors looking into 2021 and the decade ahead. So just to sum up before I turn over to Marco, again, on the economy, again, yes, we'll see double dip here on the continent, but we're focusing on the global recovery and growth in 2021. Inflation rising, but probably not an issue. And so where you want to focus on is equities and this earnings story in equity than necessarily the valuation concerns. And it's really going to be 2-pronged. So a barbell approach we're taking. On one hand, transformational growth opportunities, and Victoria will talk about one of those. And then on the other hand, quality cyclical positions, which Marco will address shortly. The last point I want to make, and I think this is very key, which Peter will touch on, this US dollar bear market that began in 2020, we think is going to be a very important key to the recovery of the overall economy. So that's going to create both opportunities and risks. So navigating this foreign exchange arena is going to be quite key for investors in the years ahead. So I'm going to stop there before I turn it over to Marco. Please remember, at any time during the presentation, you can put a question into the app, and we'll address that at the Q&A session at the end. Marco?
Thank you very much, Norman, and good morning, everyone. I just want to focus briefly on the recent events, especially in equity markets, and the implications for the medium-term outlook. We are currently looking back at a very strong month of November in terms of stock market returns, where performance was driven by 2 key events: the US election and the recent announcements regarding various anti-COVID vaccines. The 2 events led to a massive improvement in overall investor sentiment, which reached multi-year highs in the mid of November. Alongside that, implied risk in markets expressed in volatility terms has halved from about 40 to about 20%, most of which can actually be contributed to the election rather than the vaccine news. And you can see this jump in bullish investor sentiment on the right-hand side chart. On the green histogram, we have seen a massive improvement after the announcement of the various treatment options, and a jump, especially in terms of net investor sentiment, to a 3-year high. On the next slide, you see that the progress on the vaccine front has also led to a substantial sector rotation out of tech and corona winners into value and cyclical stocks, and especially those that are particularly badly hit by the global pandemic. As a result, over a 2-week period, value outperformed growth by nearly 10%. And this 10% is just the headline number. We have seen, obviously, a wide range of names that some of them went up 40, 50, 60, 70%, especially in the leisure and hospitality sector, but also in airlines and related industries. So whilst this outperformance of 10% was impressive on the right-hand side, when putting it in the perspective of a 50% de-rating that we have seen in value stocks over the last 3 years, it is hardly visible in the chart. On the next slide, just to zoom out a little bit in terms of the very long-term context, and this is the S&P compared to recessionary periods in the US since 1950, is that to some extent the recession that we are currently going through was somewhat overdue, and various financial markets, especially fixed income markets, have indicated even in 2019 that some sort of slowdown would be around the corner. So the significance of this recent medical progress in the context of a massive global fiscal and monetary easing is that in all likelihood, we are nearing the end of the current recessionary period, which is currently running at an about average duration of 9 to 12 months, having started in February of this year. On the next slide, I alluded to financial markets in a sense already indicating a beginning but also an end to the current recession, is that yield curves, which tend to be the best leading indicator for upcoming recessions and recoveries, have been signaling a re-acceleration for some time. Equally, for instance, copper prices have risen by 65% and various types of freight rates by more than 180% from their respective lows this year. All of this confirms that we could see on a global scale what happened in China over the summer months, where economic activity has picked up substantially and in some areas is now exceeding pre-pandemic crisis levels. Moving on to the equities on the next slide, to focus on the cyclical areas that we believe are quite interesting. So what are the broader implications for equity investors? As we have seen over the last few weeks, markets are now focusing on areas that benefit more directly from a recovery, especially in those segments that were hit the hardest during the crisis. Coincidentally, these are also the sectors that tend to perform the best once an economy comes out of a recession. Such cyclical sectors usually outperform the rest of the market for a period of about 2 years after the end of a recession. A strong focus on these industries is important, as overall market returns might be somewhat lagging once you are moving into the growth phase of a recovery. The interesting phenomenon, you can see this on the left-hand side of the chart, is that somewhat counterintuitively in that particular phase, valuation multiples tend to decline whilst earnings growth reaches its maximum point. Nevertheless, net, we still see a positive real equity returns over that period of time. So currently, we believe that we are somewhere between, in this particular chart, the hope and growth phase, hopefully moving into the growth period, coming out of the recession in 2021, with the implications that it has for certain sectors that we go into more detail on the next slide. So when we look at past recessions, and I just looked at the last 3 recessions, basically 1991, 2001, and 2008. So when we look at these past episodes of slowdowns, especially in the US, but also globally, there's a relatively clear and consistent picture emerging in terms of sectorial, but also country performance. And so speaking for the US, but that's broadly also the case in many other economies, is that home builders, autos, transport, and consumer discretionary stocks tend to be the best performers in the 2 years following a recession. So I mentioned this 2-year window a few times. I think there is a certain window during which cyclical sectors can perform very well, and there's a period of time where cyclical sectors are beginning to underperform. But the kind of sweet spot for cyclical exposure is a holding period of roughly about 2 years from the end of a recession, 2 years forward. As for broader market segments, emerging markets, but also small caps, mid caps, tend to outperform the rest. But also growth stocks and Nasdaq tend to perform relatively well on average over that particular period of time. This performance is broadly validated by fundamentals, as earnings growth in sectors with the best stock price performance tends to be the highest compared to the rest of the market. For us, in terms of portfolio allocations, as Norman mentioned, this entails a somewhat stronger focus going forward on cyclical areas in the equity market, where we still see attractive upside potential over the medium term, driven by earnings growth and currently still relatively attractive valuations. The only slight note of caution here is that investors need to be somewhat mindful of leverage levels that have risen substantially across many corporates over the course of 2020 as companies struggled with global demand. So in that context, only looking at stock prices or PE multiples is likely to be somewhat misleading. But still, we believe there's a very wide field of companies available that have a high balance sheet quality and very attractive growth attributes going forward to be interesting and potentially quite lucrative investment targets for medium-term investors. And with that, I would like to hand over to Peter Kinsella, Head of Foreign Exchange, who will share with us his outlook on currencies for the new year. And so if you have any questions, as you know, please put your questions in the Q&A box and we will respond to that at the end of the session. Thank you.
Great. Thank you, Marco, and good morning to everybody. My name is Peter Kinsella, and I'm the Global Head of FX Strategy at UBP. I'll get started by bringing you to the following slide, where we look at the dollar. And in our view, 2020 signaled the end of the dollar bull market, which had basically been in sort of existence since 2014. What we saw in March of this year was that the dollar index peaked, and we then subsequently saw US yield curve flatten in an aggressive manner. And as you can see from the chart on the right-hand side, looking at the US yield curve as of November compared to January, we see that the yield curve has flattened very aggressively at all tenors, but in particular at the long end of the yield curve, especially in around the 10-year sector. And what this basically signals is that the dollar has lost a permanent interest rate advantage in a very meaningful manner. Whereas 2 years ago, the dollar US 10-year rates were trading at levels of around 2.5%. Now, as of today, they're trading at levels in and around 80 basis points. So in a real meaningful sense, the dollar has lost its interest rate advantage, in particular at the long end of the yield curve. Moving to the following slide, we can basically have a look at what happens with the dollar following recessions. And what we see is that the dollar tends to weaken following very sort of aggressive style recessions, as we saw in the early 90s, as we saw following the GFC in 2008 and 9, and then as we're currently seeing during the most recent pandemic-inspired recession. And the reason for that is basically that investors no longer need the safe haven of the dollar, and they divest selling the dollar and end up buying some higher yielding currencies around the world. And indeed, this is a type of mechanism that we're currently seeing at the moment. We know that the dollar is still trading at very elevated levels in valuation terms. On both the trade-weighted index term and also in terms of real effective exchange rates, the dollar is still trading at pretty elevated levels. So in our view, the dollar still has some way to correct many of the macro imbalances, which I'm going to discuss now on the following slide. What we can see is that the US budget deficit has widened very aggressively, which is the chart on the right-hand side, to levels of around 16% of US GDP. This is a gargantuan budget deficit and has not been seen basically since the Second World War. Going into 2021, this deficit is likely to remain at very elevated levels. And the reason that this is important is that we're seeing that the US current account deficit is also starting to widen, currently printing at levels of around 4%. However, we note that because the US net national savings rate is currently printing at levels of around -1%, it means that any further borrowing will have to come from abroad, and that can only be financed by a rapid widening in the US current account deficit. So what we have is a combination of a still overvalued dollar, a dollar with no longer sort of any kind of interest rate advantage, and a very severe and ongoing deterioration in US macroeconomic balances, in particular with US external balances. And that is likely to lead to an aggressive weakening in the dollar. Previous episodes where we've seen this sort of macro imbalances play out have seen the dollar weaken by between 20 and 30% on a trade-weighted basis. And that's what we expect and anticipate over the coming years. So what does that mean for each currency pair? Well, let's go to the following slide and have a look. For the euro dollar, it basically indicates that euro may rise to levels of around 130 at a minimum to 135 over the coming years. Our view is that euro dollar will rise to levels of around 125, 126 by the end of 2021, but there are very, very clear and distinct upside risks to that forecast. The chart on the left-hand side shows you the sort of longer-term relationship between euro dollar and euro trade-weighted indice, and that basically indicates that the euro is still substantially undervalued at current levels. What we will see over the coming year is that the current account differentials between the Eurozone and the US really become very stark. And indeed, the Eurozone's current account surplus will be a large support for the euro over the coming year. So we do anticipate continued upside in euro dollar at a minimum to levels of 125 or 126. Moving to the following slide, we can then look at sterling. Sterling's had a topsy-turvy year for a number of reasons, not least the pandemic, but also the ongoing Brexit issues. And our view really is that in the short term, sterling will rise against the dollar, but this will really be a reflection of dollar weakness rather than sterling appreciation. The UK economic outlook is still rather poor over the coming year or two, and we do indeed, or will indeed, have a substantially elevated unemployment issue. The Bank of England is discussing the technical aspects of implementing a negative deposit rate policy, and indeed, in the BOE's own forecasts, it anticipates implementing negative rates at some stage over the next year. We think that's a negative for sterling, particularly in the context of an ongoing current account deficit in the UK. So all told, we do believe that sterling will rise against the dollar, but again, this is more a reflection of dollar weakness rather than aggressive sterling appreciation. And therefore, we anticipate sterling will rise to levels of around 136, but euro sterling will stay at levels in and around 0.9 with some tolerance on either side. Moving to the following slide, we can then look at the Swiss franc. As regular investors will know and clients will know, we've had a very constructive view on the franc for the last year or so. And indeed, this is broadly been the case that the franc has appreciated. We've seen that Euro Swiss has gradually declined, from levels in around 110 down to lows of around 106, and currently trading at levels of around 107. And likewise, we've seen that dollar Swiss has continued to decline, currently trading at levels of around 0.89. The large cause of the Swiss appreciation is, of course, Switzerland's huge current account surplus in and around 10%, levels of around 10% of Swiss GDP, which is an enormous current account surplus. And likewise, we're also seeing the SNB intervening very heavily in order to slow the pace of Swiss franc appreciation. To give an idea, the SNB has intervened by nearly sort of $80 billion in the past 6 months, trying to stem the pace of franc appreciation. We think this is going to be an ongoing issue, and we think that dollar Swiss will decline to levels of around 0.84 by the end of 2021. Moving to the following slide, we'll now look at gold. As you know, we've had a very constructive view on gold for about a year and a half now, and likewise that has really sort of been borne out by gold's subsequent price action. The main drivers for gold, of course, are a weaker dollar, negative real interest rates around the world, continued growth in central bank balance sheets. The corollary of this, of course, is a large growth in broad money growth, also known as M2. We now have a situation where banks are increasingly moving towards an average inflation targeting framework, which basically means that central banks will ignore inflation overshoots in the future in order to compensate for the last decade of inflation undershoots. What that means for gold is that this is still a constructive environment for gold, despite the recent small down we've had in recent weeks, which was mainly a result of the COVID-19 vaccine announcements and a subsequent portfolio shifts from gold and into stocks. Nonetheless, we're still pretty constructive on gold, and we think that gold will rise to levels of around $2,200 per ounce by the end of 2021. We do note that aggressive dollar weakness will, of course, be very beneficial for gold as the year progresses. Moving to the following slide, we can now look at CNH, which Norman alluded to a moment ago. What we have with China is a very, very stable currency, which is now trading at levels in and around 660 against the dollar. It's important to note that investors now around the world are looking for yield pickup, particularly in the context of developed market bonds, which are at very, very low levels, bond yields. This is not the case in China. Chinese 10-year bond yields trade well in excess of 3%, meaning that investors get a very significant yield pickup for allocating towards the onshore Chinese domestic bond market. We think this is going to continue to be a theme in 2021. We've already noted that monthly capital inflows towards China have trebled from levels of around $50 billion per month earlier in the year to current levels of around $150 billion per month. And we anticipate that investors will increasingly undertake these trades on an unhedged basis, which of course will lead to continued CNH appreciation. So our core view really here is that dollar CNH will decline probably to levels of around 630 by the end of the year with downside risks. And moving to the following slide, where we talk about the Australian dollar. We're very, very constructive on the Aussie dollar for a number of reasons. First, the Aussie dollar will benefit from improved terms of trade, which is basically the combination of higher commodity prices and higher commodity export quantities. And that's also indicative of Aussie dollar trading at levels of around 0.80. We've also noted that the Australian current account surplus is much, much higher than it has been at any time in the past. And this, of course, is due not just to the improving export performance, but also due to the net income from Australian foreign-owned assets. This is a structural shift for the Aussie dollar, and we think that Aussie dollar will rise substantially over the coming year. And with that, I'll now pass you to Victoria Leggett.
Good morning. Thank you very much for joining us. I'm going to spend the next few minutes talking about one of those hopefully structural areas of growth that Norman referenced earlier in the presentation. So if I take you to the first slide, this backdrop really helps to underline why we believe that environmental and social issues impact investing specifically has got a long and exciting future. So climate change has really been at the top of world leaders' agendas for quite some time. And this momentum has built. You can see that in the top right-hand corner, almost every really pressing issue, and the chart shows the biggest likelihood and the strongest impact of an event. All of this top right-hand cluster are all environmental. This is a dramatic change from a few years ago where this was much more evenly spread. So really we can see that across the globe, climate is the problem, and world leaders are really searching for answers. So if we move on to the next slide, you can see that this isn't a volte fast. This isn't something that's a very sudden change in policy since COVID-19. It's been building for quite a while. And these United Nations Sustainable Development Goals, I'm sure many of you are familiar with them now, but they were launched in 2015. All 193 UN members committed to achieving these goals. And the most important thing about this is that to achieve this, to find good solutions to these problems, costs money. It's a huge amount of capex. The estimate is $5 to $7 trillion annually, and a lot of that will come from private capital. So, as in any situation where capex is spent, there are winners and losers. There are the companies and countries and organizations who are having to fund this, and there are the companies and innovators that are providing the answers. But it's not just top down. This isn't just about governments switching on to this idea and how pressing it is. If I take you to the next slide, you can see that this is also, there's a bottom-up demand. And it's been, we've been running the impact funds at UBP for almost 3 years now, and I've been working responsible investment for a few years before that. And the momentum behind this is something unlike anything I've ever seen. And it's very interesting that investors are really starting to show their preferences. And I've been asking myself why. You know, it's not a straightforward answer, but I think there are two two things happening, and those of you in the audience are probably better placed to answer this than I am, so I'd be very interested in your thoughts. But firstly, I think people are realizing the power of their investments, not just to generate a financial return, but also to make a difference. And there's I think, a very powerful stat, which is that a €10,000 investment switched from a mainstream index into a low carbon index. That is the equivalent of a one ton of CO2 savings. So what does that mean in real life? Well, that's 1,000 kilometers driven in a Volkswagen Golf or another medium-sized car by yourself. It could also be the equivalent to 215 items of new clothing. So these decisions really matter, and I think more and more people are becoming aware of that. But also, and more critically, actually, the other reason I think is that there is an increasing recognition that far from financial compromise, this way of investing can really generate alpha. And if you look at the next slide, this was really evidenced in the pandemic. People and planet-focused investments remained really resilient through COVID-19, and in all sorts of ways. This isn't a one-trick pony. This isn't just about wind farms. This green tech, as Norman described it, this penetrates many different sectors, many different traditional sectors as you view them. So electric vehicles, they increase market share, but also this spread into health tech, remote medical services, and online payments. Renewable energy itself was incredibly resilient in spite of what historically would have been seen as really competitive, cheaper oil prices. So post-COVID, on the next slide, governments around the world, these heavily indebted governments whose job I don't envy, they have almost all, increasingly, the noise is coming from many directions, that their recovery packages have a real focus on green tech and green jobs. And so of the countries here, the amounts are really underplaying it, because I've only really put here official commitments. The $1.5 billion from China is solely on expanding the EV charging network. So there is a lot more behind that. But there's a real focus on more than just renewables. You think of green tech and you think of wind farms. So if we go on to the next slide, this shows you that in the EU specifically, this is about renovating buildings, about generating clean transport, about investing in R&D and innovation, and also in the longer term, kickstarting the hydrogen economy. So if I move on to the last slide, how does this play out in investment? Well, as I said at the beginning, any big change has winners and losers. And this is all about finding the fixers. We call them the fixers at UBP. You have blockers and adopters and fixers in the world. And it's about companies that benefit from a change in regulation. They benefit from bottom-up demand. And also they have innovation. These are companies that exist. Their revenue streams exist solely to deliver a solution, a profitable solution to a problem. So this really is non-financial and financial gain through companies who are generating real solutions now to major problems, and so face a very attractive tailwind in the coming years. And I hope I'm on time, and I'm going to hand over to Brett for the Q&A, and thank you very much for listening.
If you want to learn a little bit more about the investment outlook generally, then there is a page on ubp.com, which should be in front of you now, which you can visit. And furthermore, to stay up with the latest investment views, you can sign up to the UBP newsletter, which is also available on the website. We'll wrap it up there. We bang on time, as it turns out. Finally, just to say thanks to everyone who participated for giving us your time. I hope that you found that was useful, and thank you very much to our speakers as well for taking the time they did this morning. So thanks very much, everyone. I hope you have a super day. And I really hope that when we get together at this time next year, we can again be doing it at the Four Seasons and in person. Take care, everyone.